Welcome to the VirPoint Trading Desk. We are incredibly proud to have VirPoint as the sponsor of this deep dive today.
Yeah, absolutely.
Because, if you're navigating the crazy volatility in the markets right now, VirPoint is a leading CFD brokerage that actively blends cutting-edge artificial intelligence with expert human guidance.
Which is so crucial.
Right, and they've built this ecosystem where over 50,000 active European investors are currently trading everything from Forex and stocks down to commodities and digital assets. It's a platform engineered for precision, basically allowing you to express your market views completely seamlessly.
And honestly, having that level of precise execution is just, it's non-negotiable right now.
Yeah, it really is.
Especially when we look at the sheer velocity of the macroeconomic shifts that have materialized over the last year or so. The ground beneath the markets is, it's moving rapidly.
Which brings us directly to our mission for you today. We are unpacking the sweeping 2025 US dollar depreciation.
A massive top.
Massive. Specifically, we are diving into the slide in the dollar that really accelerated right around Liberation Day in April 2025 and essentially hasn't looked back since.
No, it really hasn't.
So we've compiled a whole stack of sources detailing what this means for global trade, how central banks are being forced to respond, and how foreign investors are defensively repositioning. And I think you'll agree with this before we get into the mechanics, we need to establish the stakes.
Oh, for sure.
Because a falling dollar is not just some isolated domestic issue for the United States.
Not at all. You really have to view the U.S. dollar as the central nervous system of the global economy.
Right.
It is the dominant global reserve currency. It's the primary invoicing tool for global trade. To put that in perspective for you, even if, say, a manufacturing hub in Japan is buying crude oil from Saudi Arabia.
Right, two completely different countries.
Exactly. That transaction is almost certainly priced and settled in U.S. dollars. It's the benchmark for major commodities. So, when the dollar depreciates, it sends these massive shockwaves through global liquidity. It dramatically shifts risk appetite, and it redistributes institutional capital flows.
And it basically alters the inflation arithmetic for practically every nation on Earth, right?
Yeah, exactly. Every single one.
Okay, let's unpack this.
Yeah.
Because to truly understand the fallout, how this shifts foreign investment yields, how it disrupts complex supply chains, and why it forces central banks to intervene, we first have to understand the gravity of the trigger.
The catalyst, yeah.
Capital is moving out of the dollar at a historic clip right now. And the sources point pretty heavily to the unwinding of the U.S. interest rate advantage as the primary catalyst starting in the spring of 2025.
Right, because the interest rate differential is essentially the anchor for currency valuation. For a long period, U.S. real rates were significantly higher than those in the Eurozone or across emerging markets. And institutional capital is, it's entirely agnostic.
It just goes where the money is.
Exactly. It flows to where it yields the most for the given risk. So when the Federal Reserve signaled a definitive pivot, basically cementing market expectations around aggressive easing and rate cuts, the basis point spread between U.S. Treasuries and foreign sovereign debt it collapsed.
It's like a bank savings account analogy, right? If you got your money in a bank paying 5% and the bank across the street pays 2%, you stay put.
Right.
But if your bank suddenly slashes its yield to match the guy across the street, you might just naturally move your cash to see what else is out there. Holding U.S. dollar assets simply lost its premium.
That's a perfect way to look at it.
But, the slide since April 2025 feels like it's being driven by more than just a narrowing yield spread. We also have to look at the massive fiscal deficit concerns.
Oh, absolutely. The sheer scale of U.S. debt issuance.
Yeah. And the questions around the long-term sustainability of those deficits really started waking up the bond vigilantes, so to speak. And at the exact same time, the global safe haven dynamic completely inverted.
And that inversion is key. The dollar traditionally acts as a wrecking ball during a global liquidity crisis because investors panic, right? They just hoard U.S. cash.
Right, they run for safety.
But as global risk appetite actually broadened and stabilized throughout 2025, investors felt highly comfortable leaving that U.S. cash haven.
They didn't need the safety blanket anymore.
Exactly. They moved out on the risk curve, seeking higher beta returns in non-U.S. assets. So you combine falling yields, fiscal anxiety, and a global risk-on environment, and you get this massive structural dollar sell-off.
I do want to challenge the narrative around this, though. Because when we see the global reserve currency sliding this aggressively, there is this huge temptation to frame it as a sign of a failing American economy, like the sky is falling.
Sure. That's the headline you always see.
Right. But mechanically speaking, isn't this just a healthy rebalancing of global capital?
What's fascinating here is that the underlying driver of the depreciation totally dictates whether the market treats it as benign or toxic.
Oh, interesting.
Right, so a falling dollar is not inherently a failure. If the decline is driven by structurally lower U.S. inflation and a proactively easing Fed, that actually creates a highly optimistic, synchronized global growth environment. Emerging markets boom, global trade expands.
So it's actually a good thing in that scenario.
Yes, exactly. However, and this is the big catch if the dollar is falling because foreign creditors have collectively lost confidence in U.S. debt sustainability.
Like a buyer strike on the Treasury market.
Exactly. If they strike, that is a malignant depreciation. That scenario drives up borrowing costs, it spikes volatility, and it drastically tightens global financial conditions. The whole market reaction hinges entirely on that nuance.
And that nuance directly feeds in to the very real dilemma facing foreign investors right now. Because if you are, say, a portfolio manager sitting in London or Tokyo, and you have this massive unhedged exposure to the U.S. equity market, this depreciation is actively cannibalizing your return.
Oh, it's just eating them alive.
Yeah. The sources spend a lot of time breaking down these currency-adjusted returns.
Because it's a brutal reality for unhedged foreign capital, institutional investors ultimately report returns in their local currency. So let's look at the actual portfolio mechanics for a second.
Yeah, walk us through the math.
Say a European fund allocates heavily into the S&P 500. The U.S. index performs well. It rallies 8% over the year. In a vacuum, that's a solid alpha generation.
Sounds like a great year.
It does. However, over that exact same window, the U.S. dollar falls 10% against the euro. So when that fund manager liquidates the U.S. equity position and repatriates the capital back into euros, the exchange rate penalty completely zeroes out the equity gain.
Wow.
Yeah, they actually print a negative return for their clients.
Here's where it gets really interesting. Because the obvious solution is to just hedge the currency risk, right? Like bringing your casino winnings to the airport. You don't want the currency exchange booth to wipe out your jackpot, so you buy a forward contract to lock in the exchange rate.
Right. But hedging isn't free.
Exactly. As the interest rate differential between the U.S. and Europe shifts, the cost of rolling those currency hedges forward can just skyrocket, which eats into the yield anyway. It makes U.S. assets structurally less attractive to foreign capital.
Precisely. You are either bleeding alpha through the exchange rate penalty, or you are bleeding it through exorbitant hedging costs. There's almost no winning there.
Damned if you do, damned if you don't.
Yeah. But we must look at the inverse of this dynamic. While foreign allocators suffer, massive U.S. multinational corporations actually experience an absolute accounting windfall.
Right, because of their overseas revenue.
Exactly. Consider U.S. tech hardware giants or global consumer staples, industrial heavy machinery exporters. A massive percentage of their revenue is generated overseas in euros, yen, and pounds.
So when the dollar weakens, the fundamental reality of their business hasn't actually changed. Like, they didn't necessarily move more units off the assembly line.
No, not at all.
But when they translate those foreign revenues back into dollars for their quarterly earnings reports, the weak dollar acts as a multiplier. Their reported U.S. dollar revenue just artificially spikes.
It's an EPS miracle, honestly, driven entirely by currency translation. But, this dynamic doesn't just stop at corporate equities. It scales all the way up to sovereign governments.
Oh, absolutely. The sources get into the recent Federal Reserve and FRE data tracking foreign official treasury holdings, right?
Yeah, through the first quarter of 2026.
Right. And it highlights these massive shifts in capital. For a foreign central bank, allocating into or out of U.S. treasuries isn't just a simple yield-chasing exercise.
No, it is a critical macroeconomic policy lever. They are managing their FX reserves to defend their own currencies and stabilize their domestic economies in the face of this huge dollar volatility.
Which bridges us perfectly away from the financial abstraction of bond yields and directly into the physical reality of global supply chains. Because a currency shift of this magnitude literally reroutes the physical flow of goods around the world.
It changes everything on the ground.
Let's look at the export side first. A depreciating U.S. dollar instantly makes American goods and services significantly cheaper for foreign buyers.
It functions as a massive, across-the-board subsidy for U.S. production. If you are, say, an American industrial manufacturer, an agricultural exporter, or even just the domestic tourism sector, a weak dollar makes you hyper-competitive.
Because it's suddenly on sale for the rest of the world.
Exactly. Your product basically just received a 10% price cut on the global market without you having to sacrifice a single cent of your profit margin.
And it's worth noting, just purely objectively, this mechanic is exactly why we've seen political figures, notably Donald Trump, historically push for a weaker dollar.
Right.
From a purely mechanical standpoint, regardless of politics,
Yeah.
if the goal is to revitalize domestic manufacturing and force U.S. factories to be globally competitive against foreign rivals,
Yeah.
a depreciated dollar is just the fastest lever you can pull to gain market share.
The economic theory certainly supports that, yes. But there is an incredibly painful flip side to this equation.
Imports.
Yes. While exports become hyper-competitive, the cost of imports skyrockets, and the U.S. economy is structurally dependent on foreign goods.
Very dependent.
Retailers importing consumer electronics, automakers relying on specialized microchips from Taiwan, logistics companies buying foreign manufactured parts. Their procurement costs surge overnight. And they do not just absorb those costs.
No, they pass them directly on to you and me, the American consumer.
Exactly. So the weak dollar essentially imports inflation right into the domestic economy.
But here is the friction point that I think a lot of people get stuck on. If U.S. exports are certainly booming because they are globally cheaper and imports are dropping because they are too expensive for U.S. companies to buy, shouldn't that dynamic instantly fix the U.S. trade deficit?
You would assume so, right? Like a simple discount code at checkout.
Right.
But the physics of global trade just do not operate like a frictionless algorithm. The sources, particularly the research we looked at from the St. Louis Fed, highlight this phenomenon known as the J-curve effect.
The J-curve.
Yes. The reality is that when a currency aggressively depreciates, the trade deficit actually tends to get significantly worse before it gets better.
Because supply chains can't just pivot on a dime.
Exactly. It all comes down to price elasticity. In the short term, a retailer's demand for imports is highly inelastic. They have already signed massive fixed-price procurement contracts months ago. The cargo ships are literally already on the water.
They desperately need those goods.
Right. They need those foreign goods to stock their shelves for the upcoming quarter. So when the dollar drops, the dollar price they pay to settle those existing contracts rises immediately. But the quantity of goods they are buying cannot adjust instantly.
Right. A supply chain manager can't just magically spin up a domestic factory in Ohio overnight to replace a supplier in Shenzhen. It just doesn't work like that.
It cannot. It takes quarters, sometimes years, to resource and physically reroute a global supply chain of that magnitude. So in the short run, the U.S. is just paying a massively higher dollar amount for the exact same volume of imports.
Ah, I see.
The price effect hits the ledger instantly. The volume adjustment lags by months. That creates the J shape on the chart. The trade deficit dips deeper into the red initially before eventually hooking back up and improving as supply chains finally adapt to the new currency reality.
The J-curve illusion. It looks like the currency shift is destroying the trade balance right up until the exact moment the physical logistics actually catch up. But because these trade imbalances and, the very real threat of imported inflation can be so economically destructive, foreign central banks can't afford to just sit back and watch the dollar slide.
No, they are forced onto the battlefield to protect their own domestic economies.
Right. Central banks fundamentally despise unmanaged volatility. Unless they are actively maintaining a hard peg, they accept that currencies will float. What they dread are disorderly, violent moves in the foreign exchange market.
Because rapid depreciation of the dollar means rapid appreciation of their local currencies. That crushes their own export competitiveness and can totally unmoor long-term inflation expectations.
So they have to fight back.
To combat this, they have a highly sophisticated intervention toolkit.
Let's examine that toolkit, because it completely dictates how global liquidity flows. The most direct method is spot FX intervention, right?
Yes, that's the big one.
This is where a central bank literally steps into the open market, using their sovereign reserves to buy or sell currency. So if the Japanese yen or the euro is appreciating too violently against the weak dollar, the central bank will print or sell their own domestic currency, flooding the market to suppress its value and use that capital to buy U.S. dollars.
It is brute force market manipulation, and it requires massive reserve stockpiles to successfully execute against the sheer volume of global FX markets. If they don't want to burn through their reserves, they can manipulate their domestic interest rates.
Oh, right.
A central bank can unexpectedly cut rates to make their local local currency less attractive to speculative capital attempting to stem the inflow. But honestly, perhaps the most vital and complex tool in their arsenal during dollar volatility is the deployment of FX swap lines.
Yeah, we see this mentioned constantly in the central bank literature. How do FX swaps actually function as a defense mechanism?
So during periods of intense currency volatility, foreign commercial banks often face a sudden liquidity crunch. They desperately need US dollars to settle global transactions or service dollar-denominated liabilities, but the open market becomes too expensive or just seizes up entirely. To prevent a systemic default, foreign central banks use FX swap lines established directly with the Federal Reserve.
Interesting.
They essentially post their local currency as collateral to the Fed in exchange for US dollars. The foreign central bank then lends those dollars directly to their domestic commercial banks. It acts as an emergency liquidity pipe, ensuring the plumbing of the global financial system doesn't just freeze up during a dollar shock.
So what does this all mean? We have spot intervention, rate manipulation, and emergency swap lines. But honestly, looking at the sources, the most utilized tool seems to be simple verbal intervention or jawboning.
Oh, jawboning is a classic.
To me, verbal intervention is exactly like a massive, intimidating bouncer standing outside a nightclub who just slowly crosses his arms and stares at a rowdy patron.
I love that analogy.
Right. The bouncer hasn't thrown a punch. He hasn't expended any physical energy. But the mere implication that he is willing to step in and use force is usually enough to make the speculators stop what they're doing.
Yeah, central bankers step up to a podium, state they're closely monitoring exchange rate levels, and the market instantly recalibrates. This raises an important question, though.
What's that?
Well, because we naturally focus on developed economies like Europe or Japan. But if we pivot and look at emerging markets, the dynamic completely flips.
Oh, right, the BIS data.
Exactly. A depreciating US dollar is a massive headache for the ECB. But for emerging markets, it actually acts as a profound economic relief valve. The Bank for International Settlements, the BIS, released detailed research on this 2025 dollar slide, specifically highlighting how a weaker dollar structurally loosens financial conditions across emerging economies.
Mechanically speaking, how does a weaker dollar stimulate an emerging market?
Through what the BIS identifies as the balance sheet channel. Historically, a staggering amount of emerging market corporate and sovereign debt is denominated in US dollars, not local currency.
Oh,
Imagine you are a major infrastructure firm in Brazil. You borrowed 1 billion US dollars to finance a new project. Your daily operating revenues are generated in Brazilian real, but your debt servicing costs are fixed in US dollars.
so when the dollar's strong, you're getting crushed.
Crushed. You have to generate exponentially more real just to cover the monthly interest?
But when the dollar aggressively depreciates, like we've seen since April 2025, the local currency cost of servicing that exact same dollar debt just plummets.
Precisely. The principal of the debt mechanically shrinks in relative terms. Their balance sheets instantly look dramatically healthier. That reduced leverage encourages local banks to expand credit, which stimulates corporate risk-taking, capital expenditure, and just broader economic growth within the emerging market. It is a massive injection of synthetic liquidity.
Wow. So we've covered the macro theory, the J-curve logistics, the balance sheet channels, and the central bank swap lines. Now, we really have to translate this for you, the listener, because knowing the why is purely academic. Executing the what next is the asset playbook.
Exactly. You have to know how to position for this.
The playbook mapped out in the sources dictates specific cross-asset rotations. In equities, a sustained dollar depreciation provides massive structural support for non-U.S. international equities, particularly in those emerging markets we just discussed.
Right.
And domestically, you'd favor the U.S. multinationals, heavily reliant on foreign revenue, while avoiding small-cap domestic firms that are heavily reliant on foreign imports.
That makes total sense based on the J-curve and the EPS windfall data.
And the commodity supercycle is also deeply tethered to this, correct?
Inextricably tethered. Almost all major global commodities, crude oil, industrial copper, agricultural staples, they are globally priced in US dollars. So when the dollar weakens, those commodities instantly become cheaper for foreign buyers holding stronger currencies. That relative discount artificially drives up global physical demand, which in turn elevates the baseline clearing price of the commodities themselves.
And if you are tracking these cross-asset ripples, and this is where the VirPoint ecosystem genuinely shines, because whether you anticipate the dollar slide accelerating or you are positioning for a hawkish central bank intervention that violently reverses the trend, You really need agility.
Agility is everything.
Through the VirPoint CFD platform, you can express these exact macroeconomic views. You can trade the actual Forex currency pairs to directly play the dollar's movement, or take positions on global commodities and international indices, all with real-time execution. It basically allows you to take this macro theory and put it into practice without any friction.
If we connect this to the bigger picture, that execution agility is paramount. An investor's playbook cannot be static. You must constantly adapt not just to the absolute level of the dollar, but to the speed of its depreciation.
The speed is key.
Yes. A slow, grinding decline allows global supply chains and central banks to adjust gracefully. A rapid, volatile slide forces abrupt, emergency policy shifts that will violently reprice your portfolio if you are caught on the wrong side of the trade.
And speaking of assets that fundamentally reprice during policy shifts, we have to look at the ultimate sovereign alternative asset highlighted in the Federal Reserve's own 2025 dollar review.
Gold.
Gold.
Gold is completely unique in this environment. The Fed's internal review explicitly acknowledged the rising share of gold in official global reserves by value. Gold basically thrives on a very specific trifecta of conditions that perfectly align with a structural dollar decline.
Which are?
Falling real interest yields, rising skepticism regarding the long-term purchasing power of fiat currencies, and a concerted effort by foreign central banks to diversify their sovereign reserves away from the US dollar to secure their own geopolitical autonomy.
Which brings us full circle. We began this deep dive by tracking the seismic shift following the April 2025 Liberation Day dollar slide. We examined how collapsing rate differentials and fiscal anxieties broke the dollar's momentum.
Right.
We mapped out the brutal currency-adjusted reality for unhedged foreign capital and the EPS windfall for U.S. multinationals. We broke down the J-curve, where the physics of supply chains force trade deficits deeper into the red before they finally recover. And we explored how central banks utilize swap lines and jawboning to fight the volatility.
It is an incredibly complex global mechanism, but every gear is turned by the US dollar's foundational role as the global benchmark. Which leaves us with a profound macroeconomic question, really.
What's that?
If global central banks, as actively noted by the Fed, by the way, continue this systematic, quiet diversification of their national reserves into alternative assets like gold, what happens when the music stops?
Right. What happens if the U.S. dollar's role as the unquestioned dominant reserve permanently diminishes over the next decade?
Exactly. If the United States loses that exorbitant privilege, the ability to effortlessly export its inflation and run massive deficits without consequence just evaporates. How does that fundamentally alter the American standard of living and reshape the baseline cost of capital for the rest of our lifetimes?
That is a staggering reality to consider, and honestly a perfect place to leave it for today. Thank you so much for joining us on this deep dive. Don't forget to explore VirPoint to harness their AI-driven insights and start expressing your views on the currency markets today. And the next time you hear a central bank governor step up to a microphone and mention they are monitoring exchange rates,
Just remember the bouncer.
remember, they aren't just reading a teleprompter. They're crossing their arms at the nightclub door, trying to keep the entire global financial system in line. Until next time.